Welcome back to another video. The account is sitting at $18,638, and it might not look like much is going on, but in fact the markets have been very volatile the last week or so, and there's a particular holding I want to talk about today. Despite contributing more money every week, this portfolio has remained about the same at $18,600. With fears looming in the markets, particularly in the financial sector, I want to capitalize on this opportunity to buy stocks at a lower price. Today, I'll be talking about one particular financial stock that I currently hold in my portfolio and continue to buy on a weekly basis. If you don't already know, there was a collapse of a bank in the US this month, and that has been leading investors astray in the financial sector, thinking that there could be other flaws in the system when it comes to banking. Particularly in Canada, our financial industry has been pretty solid over the last few decades, and I don't really see that changing going forward. So that's why I'm going to take this opportunity to buy stocks that I seem desirable right now. So the stock I'm talking about is held in my TFSA account, which is sitting at $14,902. And in the last week, you can see that it is down 4%. And that is $555. And that is no small amount of money to anyone. So the stock I am discussing today is going to be about Toronto-Dominion Bank, and I currently hold 12 shares. And not too long ago, if you've been following this portfolio, I didn't even hold this position in my portfolio at all, and now it is currently almost $1,000 position. The cost basis, I believe, is $87.17. So I started buying this a couple weeks ago on its way down. So 87, we're looking at somewhere around right here, March 6th, I started buying. And just recently, in the last week, it's actually down, look at that, 9%. And this is due to the fears surrounding this bank in America. And as this price continues to go lower, I want to be picking up more shares and more shares, because these are the moves that will pay dividends in the future, and we can compound these dividends at better prices later on. So TD Bank is at a yield of 4.5%, and I want to take a look into the dividend tracker to really see how the dividends have been growing over time, so we can get a better look about how this company operates and how it plays a role in this portfolio. Here's Toronto-Dominion Bank on the dividend tracker, and you can check out the dividend tracker below if you like this format, and you can dive into the statistics regarding dividends and free cash flows with any company you want in North America. So we can see that TD Bank has a dividend growth of 6.4% over the last 5 years annually, with a dividend streak of 31%. And the payout ratio is actually under 50% right here. So that means that TD Bank pays out 47% of its earnings to investors as a dividend, and it may use the other 50% as maybe increasing portfolio positions or increasing loan positions, however they deem necessary as a company. The market cap is $153 billion, and this is one of the biggest in Canada. Now, if we take a look at the dividends tab, we can see how this company actually grows its dividends over the last many years. So in 2022, it paid $3.56, and in 2012, there was a special dividend in 2012, but in 2011 it was $1.31. So over the last 11 years, it has actually almost tripled its dividend payout amount, which actually is a lot higher than the growth rates of most companies. So I like to take a look at the dividend and see how that is compounding over time, as well as share price, because if they both compound, you're actually getting more money on the dividend and you're actually compounding your share price at the same time. I actually love the strategy. The unfortunate thing that it does take years to do. I'm looking back 11 years, and it has almost tripled in that time horizon. Now, if you're familiar with finance, there's a rule that the S&P 500 has historically doubled an investment in about 7 years, I believe. So every 7 years, your investment should double. In this time frame, the dividend has actually over doubled, and that has been better than the S&P 500. Now, that's not to say that you won't make more money with capital gains over the long term or short term. This is just showing you the compounding effect of consistently raising dividends at a steady pace, right? So, and similarly with the cash flow is what the company can use to invest with. And in 2020, they received a lot of money through programs from the government to help businesses out, and they had a lot of free cash flow in the year of 2020. But prior to 2020, it actually has been fairly reasonable, and it's always been positive, and until recently in the last year. And some companies that are unprofitable won't even have a positive free cash flow for the duration of many years and the lifespan of the company. So the fact that they always have a positive free cash flow is very beneficial when it comes to owning this company and looking at the dividends that it pays. It seems like it's very stable. It historically has been stable. Doesn't mean it always will be, but it has been in the past. Now, they've been paying a dividend for 31 years straight, and this is significant since the payout ratio is so low. They can have room to increase this more if they desire, but they're taking a conservative route and leaving it under 50%. Some energy companies have this, and TELUS has a 90% payout ratio, which is sometimes a red flag when looking at companies. Algonquin Power is a company that was paying well over 100% of their earnings, thinking that investors are seeking these dividends, but it's unsustainable for long periods of time, and that's why you saw Algonquin Power take a tumble. If you want to check out that video, there'll be a link in the description. You might get some insight on why Algonquin Power collapsed a little bit. But I see TD Bank being okay in the near future. If earnings and revenue doesn't really grow, they can still continue to grow their dividend, and until they reach a threshold that puts their payout ratio in danger. Maybe it's at 60 or 70 plus percent. So there is room to work with when it comes to the dividend payout ratio, which I really do like going forward. So when I take a look at TD Bank over the course of its lifetime, it's been around since the 90s, and it's actually been on a very predictable, steady trajectory over the last 20 years, since 2000 almost. And it hasn't been until COVID that it really has been a little bit more choppy. And I really do predict that this is going to be fairly similar in the near future. And over this pullback, I want to actually be increasing my position to set this up for a more sustainable climb in the future. So going forward, I'm just going to be purchasing more shares of this when I can. I know that lots of ETFs that I hold, like VDY, I hold a big position in VDY, has a large position in Toronto Dominion Bank as well. So I am overweight Toronto Dominion Bank, but I think it is going to be a stock at these levels is going to perform very well over the long term, especially with that dividend that we can continually reinvest into our portfolio and buy more stocks that we like. So in saying that, I will be just going through my portfolio really quick just to give you an update on my other accounts. So like I said, the TFSA is sitting at just under $15,000 at $14,900. The RSP is at $2,070 USD. This is the only account that I like to buy dividend stocks in USD. My personal account has some USD as well, has more Berkshire. Let's go into the RSP quickly here just to see how these stocks have been doing over the same pullback. So this RSP is down 3% in the last week, where the TFSA was down 4%. So slightly better improvement on that. And this holds VOO, SCHD, QQQ, and LQD. So in my personal account, I really only hold VOO, which is what I use with my 1% cashback. Berkshire Hathaway, I hold almost 2 shares at 566, but they're actually under $300, and they've actually been trading over $300 over the last few weeks and months as well. And this portfolio is down 4% as well, so similar to the market average. Before we go, let's just check out the S&P 500's 1 week return just to see how our portfolios have been. So the S&P 500 has been down 3% in the last 5 days. In the last month, down 5%. So a little bit different than our portfolio, but somewhat similar. It's been down multiple percent in the last week or so. And I predict that is because my portfolio has more financials, and that is what has been on the downturn in the last few weeks has been financials almost all over the world. So it's been a common theme within that industry. If you like this content and you want to stay up to date to these portfolio updates, like and subscribe. And if you want to check out the Dividend Tracker or Blossom, where I regularly update my trades, see you next time.